Welcome to Intelligence Gateway.
Hello. Today we are going to learn 5th module of Financial Analyst, and 5th module is Capital Budgeting and Investment Analysis. Evaluating investment opportunities. Evaluating investment opportunities involves assessing the potential risks and returns associated with a particular investment. It is a crucial step in making informed investment decisions. Here are some key factors to consider when evaluating investment opportunities. Investment objectives. Clarify your investment objectives, whether they are focused on capital appreciation, income generation, diversification, or long-term wealth preservation. This will help you align the investment opportunity with your goals and risk tolerance. Risk assessment. Evaluate the risk factors associated with the investment. Consider factors such as market volatility, industry risks, regulatory changes, competition, and the specific risks inherent to the investment itself. Assess the potential impact of these risks on your investment and determine if you are comfortable with the level of risk involved. Financial analysis. Conduct a thorough financial analysis of the investment opportunity. Review historical financial statements, including revenue, expenses, profitability, and cash flow. Analyze key financial ratios to assess the company's financial health and stability. If evaluating a project or real estate investment, consider factors like projected cash flows, return on investment, and the viability of the business plan. Market analysis. Evaluate the market dynamics and trends relevant to the investment. Assess factors such as market size, growth potential, competition, and barriers to entry. Consider how the investment opportunity aligns with market demand and whether it has a competitive advantage or unique value. Proposition. Management team. Assess the competence and experience of the management team or individuals behind the investment opportunity. Evaluate their track record, industry expertise, and their ability to execute the business plan or investment strategy. A strong and capable management team. Team is often a key factor in the success of an investment. Due diligence. Conduct for due diligence to verify the accuracy of information provided and to uncover any potential red flags or hidden risks. This may involve reviewing legal documents, contracts, licenses, permits, or conducting background checks on key individuals or entities involved in the investment. Exit strategy. Consider the exit options available for the investment. Evaluate factors such as liquidity, potential for capital appreciation, and the time frame for achieving your investment objectives. Understanding how you can exit or liquidate your investment will help in determining the suitability of the opportunity. Diversification. Assess how the investment opportunity fits within your overall investment portfolio. Diversification can help spread risk and potentially enhance returns. Evaluate whether the investment aligns with your portfolio diversification strategy and how it may interact with your existing investments. Proposals. Advice. Seek advice from qualified professionals such as financial advisors, investment analysts, or industry experts to gain additional insights and perspectives on the investment opportunity. They can provide expert guidance and help you make informed decisions. Remember that evaluating investment opportunities requires a careful and systematic approach. It is essential to thoroughly understand the investment, its potential risks and rewards, and how it aligns with your specific investment objectives and risk tolerance. Conducting comprehensive research and analysis will increase your chances of making informed investment decisions. Net present value (NPV) and internal rate of return (IRR). Net present value (NPV) and internal rate of return (IRR) are both financial metrics used in investment analysis to assess the profitability and viability of a project or investment opportunity. They help in evaluating the expected cash flows and determining whether the investment is worthwhile. Net present value (NPV). Net present value calculates the present value of expected cash flows generated by an investment. Taking into account the time value of money, it measures the difference between the present value of cash inflows and the present value of cash outflows over the life of the investment. The formula for calculating NPV is NPV equals sigma CFT 1 plus RT, initial investment, where CFT represents the expected cash flow and period TR is the discount rate or required rate of return represents the time period. If the NPV is positive, it indicates that the investment is expected to generate more cash inflows than the initial investment, potentially making it a profitable opportunity. On the other hand, a negative NPV suggests that the investment may not generate sufficient returns to cover the initial investment and meet the required rate of return. Internal rate of return (IRR). Internal rate of return is the discount rate at which the NPV of cash inflows equals the NPV of cash outflows, resulting in a zero NPV. In other words, it is the rate of return that makes the present value of cash inflows equal to the present value of cash outflows. The IRR represents the annualized rate of return the investment is expected to generate over its life. To calculate the IRR, you solve the NPV equation for the discount rate R that makes the NPV zero. This is typically done using trial or with the help of financial software or calculators. The IRR is compared to the required rate of return or hurdle rate to assess the attractiveness of the investment. If the IRR is higher than the required rate of return, the investment is considered potentially worthwhile. Conversely, if the IRR is lower than the required rate of return, the investment may not meet the desired level of profitability. Both NPV and IRR are valuable metrics in investment analysis, but they have their limitations. NPV provides a dollar value that allows for a direct comparison between investment opportunities. IRR, on the other hand, provides a percentage return, which is helpful for comparing different investment options based on their expected rate of return. However, IRR may have limitations in certain scenarios, such as non-conventional cash flows or when comparing projects with significantly different cash flow patterns. It is important to use these metrics in conjunction with other financial and qualitative factors when evaluating investment opportunities to make well-informed decisions. Payback period and profitability index. Payback period and profitability index are two additional financial metrics used in investment analysis to evaluate the feasibility and profitability of investment opportunities. Payback period. The payback period measures the time it takes for an investment to recover its initial cost. It indicates how quickly an investment generates cash flows that recoup the initial investment. The formula for calculating the payback period is payback period equals initial investment / annual cash flow. Payback period is expressed in years or months, depending on the desired level of granularity. A shorter payback period is generally considered favorable as it indicates a faster return of the initial investment. However, the payback period alone does not account for the time value of money or the cash flows beyond the payback period. It is often used as a preliminary screening tool to assess the liquidity and risk associated with an investment. Profitability index. The profitability index, also known as the benefit cost ratio (BCR), measures the relative profitability of an investment by comparing the present value of expected cash inflows to the present value of cash outflows. The formula for calculating the profitability index is profitability index equals PV of cash inflows, PV of cash outflows. The present value PV is determined by discounting the future cash flows using an appropriate discount rate. A profitability index greater than 1 indicates that the investment is expected to generate positive net present value and is considered profitable. The higher the profitability index, the more favorable the investment. It provides a quantitative measure of the value created per unit of investment. The profitability index is particularly useful when comparing investment alternatives with limited capital or when seeking to maximize returns within a constrained budget. It helps rank investment opportunities based on their potential profitability, considering the time value of money. However, like other financial metrics, it should be used in conjunction with other qualitative and quantitative factors to make well-rounded investment decisions. Both the payback period and profitability index provide useful insights into the financial aspects of an investment. The payback period emphasizes the time required to recover the initial investment, while the profitability index focuses on the relative profitability and value created by the investment. Capital budgeting decision-making techniques. Capital budgeting decision-making techniques are used to assess and analyze investment projects or expenditures that involve significant cash outflows, with the expectation of generating future cash inflows. These techniques help in evaluating the financial viability, profitability, and overall impact of potential investments. Here are some common capital budgeting techniques. Net present value (NPV). NPV assesses the value of an investment by calculating the present value of expected cash inflows and deducting the present value of cash outflows. A positive NPV indicates that the investment is expected to generate more value than the initial investment, while a negative NPV suggests that the investment may not meet the desired level of profitability. The decision rule for NPV is to accept projects with a positive NPV and reject those with a negative NPV. Internal rate of return (IRR). IRR, the discount rate at which the present value of cash inflows equals the present value of cash outflows, resulting in a net present value of 0. It represents the rate of return an investment is expected to generate. The decision rule for IRR is to accept projects with an IRR higher than the required rate of return or hurdle rate. The higher the IRR, the more attractive the investment opportunity. Payback period. The payback period calculates the time required for an investment to recover its initial cost. It measures the length of time it takes to recoup the cash outflows with expected cash inflows. The decision rule for the payback period is typically a predetermined benchmark, where shorter payback periods are considered more favorable. However, the payback period does not consider the time value of money and ignores cash flows beyond the payback period. Profitability index (PI). The profitability index, also known as the benefit cost ratio (BCR), compares the present value of expected cash inflows to the present value of cash outflows. It helps evaluate the value created per unit of investment. A profitability index greater than 1 indicates a potentially profitable investment, with higher values representing more favorable opportunities. Discounted payback period. Similar to the payback period, the discounted payback period considers the time required to recover the initial investment. However, it accounts for the time value of money by discounting the cash flows. The decision rule for the discounted payback period is typically a predetermined benchmark, where shorter discounted payback periods are considered more favorable. Modified internal rate of return (MIR). MIRR addresses some of the limitations of the traditional IRR. By assuming reinvestment of cash inflows at a specified rate and borrowing at a different rate, for cash outflows, it aims to provide a more realistic rate of return calculation by accounting for cash flow reinvestment and borrowing costs. These capital budgeting techniques help in assessing the financial feasibility, profitability, and risk associated with investment projects. It's important to use multiple techniques and consider qualitative factors alongside quantitative analysis to well-informed capital budgeting decisions. Additionally, these techniques should be applied in alignment with the specific requirements and objectives of the organization or investor. Risk assessment and sensitivity analysis. Risk assessment and sensitivity analysis are important components of investment analysis and decision-making processes. They help identify and evaluate the potential risks and uncertainties associated with an investment, as well as assess the impact of key variables on the investment's outcomes. Let's explore each concept further. Risk assessment. Risk assessment involves identifying and analyzing the potential risks and uncertainties that may affect an investment. It helps in understanding the downside risks, potential losses, and the overall risk profile of the investment opportunity. Here are some steps involved in risk assessment. Identify risks. Identify and categorize various types of risks that may impact the investment. These can include market risks, financial risks, operational risks, regulatory risks, competitive risks, and macroeconomic risks, among others. Assess probability and impact. Evaluate the probability of each identified risk occurring and assess its potential impact on the investment's cash flows. Profitability and overall value. Consider both the likelihood and severity of each risk. Quantify and prioritize risks. Quantify the potential financial impact of each risk, either in absolute terms or as a percentage of the investment. Prioritize risks based on their significance and likelihood of occurrence. This helps in determining which risks require mitigation or management strategies. Develop risk mitigation strategies. Develop strategies to manage and mitigate the identified risks. This may involve implementing risk management techniques such as diversification, hedging, insurance, contingency planning, or operational improvements. Sensitivity analysis. Sensitivity analysis assesses the impact of changes in key variables or assumptions on the investment's outcomes, such as cash flows, profitability, or valuation. It helps understand the sensitivity of the investment to various factors and enables decision makers to evaluate the robustness of the investment's expected results. Here's how sensitivity analysis is typically conducted. Identify key variables. Identify the critical variables or assumptions that significantly influence the investment's outcomes. These can include factors like sales volume, price, cost, interest rates, inflation rates, or exchange rates. Define scenarios. Define different scenarios by varying the key variables one at a time while keeping others constant. For example, consider a best-case scenario with optimistic assumptions, a base-case scenario with expected assumptions, and a worst-case scenario with conservative assumptions. Assess impact. Quantify and assess the impact of each scenario on the investment's results. Analyze the changes in cash flows, profitability, net present value, and PV, internal rate of return (IRR), or other relevant metrics. Sensitivity graphs or tables present the sensitivity analysis results in the form of graphs or tables to visualize and communicate the impact of changing variables. This allows decision makers to understand the range of potential outcomes and make informed decisions. Sensitivity analysis helps in understanding the risk and uncertainty associated with an investment by considering different scenarios and assessing the range of possible outcomes. It enhances decision-making by providing insights into the investment's resilience and vulnerability to changing market conditions or assumptions. Both risk assessment and sensitivity analysis are valuable tools in investment analysis. They complement each other by identifying risks upfront and then evaluating their potential impact on the investment's performance by integrating risk assessment and sensitivity analysis into the decision-making process. Investors can make more informed and robust investment decisions.
Thanks for watching. For more information, like, comment, and subscribe our channel.